Haven't cut my hair for like six months. I'm gonna have like hair I can just flip around like crazy one day. So soon. 6 more months, you'll see. All right, so I'm gonna start off this video by saying that I'm no expert and no guru when it comes to stock market investing. Far from it, actually. I do have a good amount of experience. Started investing in the stock market like 12 years ago in college. So I do have a good amount of experience, but by no means an expert. I do have enough knowledge that a lot of friends and family come up to me and they ask me how should they get started in stock market investing and what type of stock should they buy and what type of resources should they look at in order to learn more about stock market investing. And I usually just tell them that I learned through some books and they should just go and read some books to learn about stock market investing. But I realized that that's not really a great answer. So I decided to sit down, come up with the guidelines that I use when I invest in the stock market and give some guidelines for new people on how they should invest in the stock market. So it should be a pretty interesting video. It should be pretty useful to a lot of people. And I just want to also give a quick disclaimer that stock market investing in general is not exactly a science. And a lot of people have different opinions, and anyone who has a different opinion than me is wrong. Damn it. Just kidding. I could definitely be wrong myself. I've formed opinions over the past 12 years that I thought a lot about. I do think they're right. I do have confidence in them, but I do also realize that they also can be wrong. So let's get right into it. First off, what is a stock? A stock is simply just a representation of a company. And a stock share specifically represents a part ownership stake of that company. So for example, let's say that you and 100 of your closest friends own a company called the Kitty Daycare Corporation. Actually, you and 99 of your closest friends own the company. So 100 people total own the company. Okay, back to the video. Let's say that each one of you own an equal percentage of that company. So each of you own 1%. And you guys, some people want to sell their percentage of that company. Some people want to buy. So what you guys do is you guys split that company into 100 equal shares. So each share is worth $1 million divided by 100 or $10,000. Each share is worth $10,000. So now everyone is free to buy and sell to each other for a $10,000 share. But let's say that some people, they just want to sell a percentage of that company. So instead of dividing their company into 100 shares, let's say instead you guys divide your company into 1,000 shares. Now each share is worth $1 million divided by 1,000 or $1,000 each. So now you guys are free to trade at $1,000 increments, right? Or let's just say that you guys want to divide the company into 1 million shares. So now each share is worth $1. So really the amount of shares that you guys divide the company into is really just arbitrary. It doesn't matter. So you can see that the stock price isn't really an indication of how much the company is worth. It's just an indication of how many shares are out there. It doesn't really matter if the stock is at $1 or $10,000. It doesn't mean the $1 stock is cheap or the $10,000 stock is expensive. In this case, they just represent different ownership percentages of the same company. So I just bring this up because it's just one of the most common mistakes that I see beginners make. They think that just because a stock is worth $5 that it's cheaper than a stock that's worth $500, for example. But this is not the case. So yeah, the stock price doesn't matter. So what really matters is the overall value of that company. So for example, Kitty Daycare Corporation, right? Let's say that company is worth $1 million. But let's say that investor wants to come in and they want to buy the company for $2 million. So that would be considered an expensive deal for the new investor. Or let's say that the investor comes in and they offer $500,000 for the company that's worth $1 million. That would be considered a pretty cheap deal for the investor if everyone decides to take that deal. So now that we know what a stock is, how do we start investing? So there's a couple of things I would recommend before you start investing. The first thing is if your company offers a 401k match, you should contribute to your 401k up to the match. That's number one. The second thing you should do is you should pay off all your credit card debt. And then the third thing you should do is you should open a Roth IRA. And this is where you're gonna start investing into your Roth IRA. So what is a Roth IRA? So a Roth IRA is simply an account that you can deposit money into, and you can use that money to make investments where those investments are invested in a tax advantage way. There's also something called a traditional IRA. And I'm not going to get into the differences between what a Roth IRA is and what a traditional IRA is, what the differences are, because that's going to require a totally different video. But just know that Roth IRA is better than a traditional IRA. They're both good, but the Roth IRA is better. The main benefit of the Roth IRA is that the profits are not taxed within the Roth IRA. So any stocks that you sell within the Roth IRA, any dividends that you receive through the Roth IRA, not taxed. As long as you leave the profits within the Roth IRA until you are at least 59 and a half years old. So you might be thinking,
oh my God, I don't wait that long to retire. 60 years old, that's so old.
Okay, look, I hear you, right? I don't plan to retire at 60 years old either. I want to retire earlier than that. But first off, any contributions that you make into your Roth IRA can be withdrawn at any time, tax-free and penalty-free. So let's say that you're 25 years old and you contribute the maximum to your Roth IRA until you're 45 years old. So at that point, you probably would have invested close to $150,000 into your Roth IRA. And let's say that there's like a really great investment opportunity, a real estate investment opportunity over here. You can take that money, $150,000 out of your Roth IRA, put it into your real estate investment, and it's tax-free, and you can use your real estate investment as part of your retirement strategy. So it's not like your money is not accessible, and there's actually a ton of ways to even withdraw your money penalty-free but not tax-free, where if you had invested in a regular taxable account, you would have been taxed anyways. So there's really no disadvantage of using a Roth IRA, and a ton of advantages. But this is not supposed to be a video about the advantages of Roth IRAs. It's supposed to be a video about how to invest in the stock market. So enough about Roth IRAs. Just the main takeaway, use them. Don't listen to YouTubers that don't use them. They are either special circumstances or they're ill-informed. All right, so to set up your Roth IRA, you need to pick a brokerage. So you can't really go wrong these days with picking a brokerage because they all offer free trades now. I use TD Ameritrade. You can use other brokerages that have free trades. There's Chase U Invest, there's Fidelity, there's E-Trade, there's some other ones out there. So you can use pretty much any one of those and you can't go wrong. But I also wouldn't use Robinhood because they don't offer Roth IRA right now. The next thing you want to do is you want to pick an investment. So I think that 80 to 90% of the people out there, especially if you're a beginner, should invest in index funds. There is no homework involved. You just pick your investment and you just leave it there on autopilot. So what is an index fund? An index fund is also known as an exchange traded fund or ETF. And it's a type of investment that tracks the performance of a group of stocks. So for example, you can have an index fund that tracks the performance of the S&P 500, which is a collection of the 500 largest companies in the US. Index funds are kind of similar to mutual funds, except that a mutual fund it's also an investment, but it's an investment that is managed by a mutual fund manager, a money manager that actually picks individual stocks. The advantage of an index fund is that it tends to outperform the individual investor. And almost by definition, it gives the average return of the professional investor. But after you factor in the fees that a professional would charge, it also outperforms the professional investor. So over a 10-year period, if you look at a low-cost index fund, it will outperform a similar mutual fund, which, like I said, is managed by a professional money manager over 80% of the time. When you pick an index fund, one of the most important factors to look at in an index fund is the expense ratio, which is the fee that the index fund charges in order to keep the fund running. Vanguard has some of the best index funds out there, if not the best index funds out there, because they charge a very low expense ratio, usually under 0.1%. This is really good compared to mutual funds that usually charge somewhere between 1 and 3%. Some of the index funds that I recommend are VOO, which tracks the performance of the S&P 500, VBK, which tracks the performance of small cap growth companies, and VNQ, which is a real estate investment trust index, which is a collection of companies that manage real estate. So even though I think that most people should invest in index funds, I still think it's important to have a general idea of how to value a stock. So I'm going to go through some of the things that I look for when buying a stock. So the first and most important thing you want to look at is the company's PE ratio, or price to earnings ratio, which basically tells you how many years it would take for you to get paid back if the company stopped growing its earnings. And this makes a lot of sense because let's say that you're out there and you want to buy a company outside the stock market. The first thing you want to ask is how much is the company selling for? And the next thing you want to ask is how much earnings is that company making per year, or profits making per year? So let's say that you come across a company called Kitty Daycare Company, right? And it's selling for $1 million. And Kitty Daycare Company makes $100,000 per year. So you take the price, $1 million, divide by the earnings, 100,000, and you get the PE ratio of 10. It's the exact same thing when you look at stocks. For stocks, you look at the stock price and you divide by the earnings per share and you get your PE, price to earnings ratio. You could also take the market capitalization, which is how much the overall company is worth, divided by net income, which is the profit of the entire company, and you'll get the same number. So when we talk about if a stock is expensive or cheap, we're really talking about PE. So if a company has a high PE, that means the stock is expensive. If a stock has a low PE, that means the stock is cheap. So what's a high PE and what's considered a low PE? So I would say anywhere under 5 to maybe 13 would be a really good PE in the stock market right now. But that might be an indication that there's something wrong with that stock. There may be something going on with that company, like maybe that company is not growing anymore, or there may be even risks of bankruptcy. And anywhere from 14 to 21-ish would be considered reasonable in the stock market right now. And anything 22 to like 30 plus would be considered expensive in the stock market. But that might just be an indication that that company is growing at a fast rate, or that's just a high quality company. The best strategy, in my opinion, is to find a high quality company at either a reasonable PE or even a slightly expensive PE. And Charlie Munger says it best. He's the investment partner of Warren Buffett. A great business at a fair price is superior to a fair business at a great price. Companies with really low PEs are hard to analyze because there's usually something else going on with the business that is hurting that business. Whereas if you buy a high quality business at a reasonable PE, most of the time you could just set it and forget it. I just wanted to note that I'm reporting this in the midst of a pandemic, so PE ratios are really high right now because companies' earnings are affected by lockdowns and high unemployment rate. And it might just make more sense to look at 2019 PE ratios to get a better idea of how a company would perform under normal circumstances. And also, PE ratios are inversely correlated with interest rates. With low interest rates, PEs tend to go higher because people are more willing to pay for stocks, because going through the risk-free route, like buying treasury bonds, it's just not worth it. The returns are too low. But if interest rates are high, then it pushes PEs lower because people would just rather not buy stocks and go through the risk-free route. So like I said, you want to find a high-quality company with a reasonable PE. But how do you know what a high-quality company is? The first thing I look for is their brand. Do they have a great brand? And the next thing I look for is their executive team. I want to see if they have a great executive team, especially the CEO. And I'll kind of go over how I determine if they have a great executive team later. The next thing I look for is their financials. And the things I look specifically is, one, their profit margin. I want to see if their profit margin is larger compared to their peers. And the next things I look for are their revenues, their net profit, and their shareholders' equity. I want to see all three of these numbers grow over time. And obviously, the faster the growth, the better. And if those things don't make sense to you right now, that's okay. I'll explain a little bit later, and I'll show you where to find those numbers. So the first type of stock I would recommend people buy would be in a company that is, one, large and also profitable. because a large company, it's easier to access information from a large company. And a company that is profitable has a PE ratio, obviously, where a company that doesn't have profits doesn't have a PE ratio. For a company that doesn't have profits, the analysis is similar, except that an analyst would try to predict how much profit a company would have once the company matures, and then they would try to come up with a reasonable price that people would be willing to pay for that stock today. So where do you find all this information that I mentioned previously on a company? So the first place that you can look at is Yahoo Finance. Here you can find the basic information like the stock price, the market capitalization, which, like I said, is what the overall company is worth. You can find the PE ratio, you can find the dividend rate, and if you go to the financials, and here it gets a little bit more complicated, so pay attention here especially. You can go to the income statement where you can find gross profit, which is their revenue minus cost of goods sold. Or an easier way to think of this is just their profits before expenses. You can also find net income, which is also known as net profit. And yeah, this is a little confusing. So basically you could think of gross profit is profit before expenses, and net income or net profit is profit after expenses. All right, so on balance sheet, you can look at the breakdown of all the assets, which is everything that adds value to the company. So assets add value to the company, and there's the liabilities, everything that takes away from the company's liabilities takes away value from that company. You can also see how much cash they have. You could see their account receivables, meaning how much money their customers owe them. You can see their inventory. You can see debt levels and other liabilities, and you can also see their stockholders' equity. Stockholders' equity is all their assets minus all their liabilities. So obviously you want to see their stockholders' equity grow over time. The next place I would look at would be on YouTube, and I would try to find CEO interviews of the company that you are interested in purchasing stocks of. And what I would look for in that CEO is I would try to gauge if that CEO is capable of extraordinary accomplishments. And I would see if that CEO is particularly insightful, or if I can learn something from that CEO, if that CEO is a great teacher, a great communicator, or if that CEO is just an empty suit that cares about numbers, or if that CEO is just a salesman. So after you do those things, you want to go on the company's investors relations site, and you want to listen to the latest financials earnings call. So you want to do this, but you won't get a ton of value from the actual content, because as a new investor, they're just going to talk about a lot of financial mumbo jumbo stuff that you won't really understand. But what you want to really listen to is you want to listen to the executive team, and you want to see how they answer questions from the other analysts, and you want to see if they really know their shit, basically. If they know their business inside and out, if they seem competent, and if they seem like effective communicators. On their investors relations site, you can also find their 10Ks, which is their annual filings, and you can also see their 10Qs, which is their quarterly filings. You can find a lot of the information from the 10Ks and the 10Qs through Yahoo Finance, but sometimes there are errors on Yahoo Finance. So if anything looks weird on Yahoo Finance, then you can just go on the investors relations site and verify using the 10Qs and the 10Ks. So now that you did all this research and you decide that this is a company that you want to invest in, let's go ahead and actually buy some shares of this company. But quick note though, before you buy, just know that if you do a ton of research, it might bias you towards buying that company, buying stock in that company, because you would have felt like you've done all this research and wasted your time if you end up not buying any stock. So just know that it's perfectly fine to do a ton of research and end up not buying any stock. All right, so there are two ways to buy a stock: through a market order and a limit order. A market order, it buys a stock at whatever the market price is. So if there's a stock that is trading at $100 currently, and you put in a market order, then you'll end up buying that stock for $100 per share. pretty self-explanatory. A limit order, on the other hand, doesn't execute until the stock reaches the price that you set for it. So if the stock is currently trading at $100, you can set a limit order at $95, and you will not end up purchasing the stock unless that stock reaches $95 or lower. So I buy almost everything with a limit order, and there is a chance that if you have a limit order too low that it may never execute and you would have lost the opportunity to buy a stock at a certain price. So what you can do to reduce your fear of missing out is you can have a market order just to buy an initial position, and then have limit orders to buy additional shares at a lower price. And if you do use limit orders, you should set it at good till cancel, or GTC. And that way you'll have that limit order will stay in place for the next 90 days or until you cancel. Boom, there we go. If you followed everything in this video, then you are now in the market. So a little bit of parting advice. Don't try to time the market, just invest in the market for the long term, and don't be like me. How was I supposed to know that Tesla would be at $2,100 right now? I would have so much money. All right, I'm good. Well, okay, so a couple other advices. You can go ahead and actually read some books like I did. I think books are helpful, but I think a better approach would just be to watch book summaries on YouTube on the books that you want to read. So it's just a more efficient use of your time, and you can just get the key takeaways with just like a fraction of the time, like 1% of the time that it would take to read a book. The 3 best books that I read on investing were, number 1 was A Random Walk Down Wall Street. Number 2 is The Intelligent Investor. And number 3 is Warren Buffett's biography called The Snowball. So that's my beginner's guide to the stock market. If you have any questions, just comment below and I'll probably respond unless this video is like 10 years old. Otherwise, thanks for watching, and I'll see you